What is up, guys and girls, and welcome to DecDoesInvesting, the wealth, investing, and finance channel. Before we start, I'd like to ask you to hit the subscribe button to join me on my journey, and also hit the like button to help me out with the YouTube algorithm. In today's video, I have 3 UK stocks that are going ex-dividend soon that are currently attractively priced. However, I would like to point out that this video is just for entertainment purposes and should not be taken as financial advice. As always, you should do your own research before purchasing any stocks, as your money will be at risk. The first company on my list is Unilever, which has the ticker symbol ULVR. Unilever is a British-Dutch transnational consumer goods company, and its products include food, energy drinks, ice cream and beverages, cleaning agents, beauty products, and personal care products. Some of Unilever's products include Ben & Jerry's, Marmite, PG Tips, Dove, and Lynx, to name a few. Looking at Unilever from a financial standpoint, starting first with its share price, we can see that it has been on a downward decline since the 3rd of September, in which its share price was £53.24, and at the time of making its video it is currently trading at around £41 per share. However, despite this decline, if we look at Unilever's shareholding returns, we can see that over a 5-year period, Unilever has returned 64.4%, which betters that of its industry, which saw negative returns, and also bettered that of the market, which returned a measly 3.6%. Simply Wall Street and their analysts currently undervalue Unilever by 40.8% in comparison to its fair value, which is a massive discount for a colossal company like Unilever, which has returned so well over the past 5 years. Looking at Unilever's future growth forecasts, we can see that its earnings growth is expected to be around 7%, which lags that of its industry of 8.8% and also the market of 19.6%. Also, its future revenue growth is expected to only be 2.6% in comparison to the industry of 10.9% and the market of 3.2%. However, we must take into consideration that we are investing in a company that is no longer in its growth phase and in fact very much a conservative stock which pays a reliable dividend. Analysing Unilever's past earnings, we can see that it's returned 12.2% in comparison to the industry of 31.5% and the market of 13%. From this, we can see that over a 5-year period, Unilever has somewhat mirrored that of the market. However, it has lagged the industry, which must be taken into consideration. However, over the past year period, it doesn't look great for Unilever, which has returned a negative return of 40%, in which the industry it finds itself returned 88.2%, and the market also returned 3.4%. Now, if we look at Unilever's financial state of play, we can see that it doesn't cover its short-term liabilities of 21 billion, nor does it cover its long-term liabilities of 29.4 billion. Finally, looking at Unilever's dividend, we can see that it currently has a yield of 3.6% and its ex-dividend date is on the 14th of May, which still gives you time to go and purchase it and claim that dividend, which it will pay on the 4th of June. Looking at how that dividend compares to the market, we can see that the yield is greater than the lowest paying 25%, however lower than that of the highest paying 25%, finding itself somewhat in the middle. Unilever does pay a higher yield on average than its industry, and its current yield is expected to rise to 4% in the next 3 years. Unilever pays a stable and growing dividend, which it has been paying since 1990. Finally, to wrap Unilever up, we can see that its current payout ratio is 76%, and this is also expected to drop to 70% in the next 3 years, meaning that its dividend is well covered. The next stock I have on my list is Royal Dutch Shell, which has the ticker symbol RDSB for my UK investors. Now, this is more of a slightly riskier stock with how the current oil market stands, and also the fact that Shell have also announced that it is cutting its dividend. However, I still feel like it's a great potential buy long term if you're more of a risk taker. Starting with its share price, Shell has been on a bit of a downward cycle since its highs of £28.41 back in May 2018, and it is now trading at around £12 per share at the time of making this video. Simply Wall Street and its analysts currently undervalue Shell by 37.2% in comparison to its fair value, which means there is a discount to be had right now. If we now look at Shell's forecasted annual earnings growth of 37.1%, this is very impressive despite lagging that of its industry of 44.9%. However, it is much greater than that of the market of 19.6%. Shell's forecasted growth is expected to be 11.7%, which is greater than both the industry and the market, of which are expected to grow 11.4% and 3.2% respectively. Looking at Shell's past growth, we can see that it grew 29%, which is only just short of the industry of 30.7%, and was much greater than that of the market of 13%. However, over the past year, Shell has returned a negative 58.1% return, which can be put down majority to the oil trade war and the current pandemic. Moving on to Shell's financial health, we can see that it covers its short-term liabilities, however doesn't cover its long-term liabilities of 134.3 billion, which we will have to take into consideration with the current oil market and the future of it going forward. Now looking at the dividend yield of Shell, we can see that despite it cutting its dividend, it still boasts a decent return of 3.76%, with its ex-dividend date being on the 14th of May, of which is to be paid on the 22nd of June. If we look at Shell's dividend in comparison to the market, we can see that it falls between the highest and the lowest paying 25%. But with its dividend cut, it now pays much below the industry of 8.9%. However, I do expect the industry to also have many dividend cuts in the future and for this value to drop. However, Shell's dividend isn't well covered at the moment, with its payout ratio of 128%. This is expected to drop to 69% in the future, however. This is why I said it's a stock for those more risk-taking people who believe in the future of oil. And finally, the last stock I have on my list is GlaxoSmithKline, which has the ticker symbol GSK. GSK, as I will now refer to them as, are a pharmaceutical company who develop, create and manufacture pharmaceutical products. In the not too long distant past, GSK was trading at its high of £18.46, and at the time of making this video, GSK is currently trading at around £16 per share. If we now move on to its shareholding returns, we can see that it has returned an impressive 43.9%, which is lower than the industry of 73.7%, but much higher than the market of 3.6%, which is impressive for a company of GSK's size and market cap. Simply Wall Street and its analysts currently undervalue GSK by 41.7% in comparison to its fair value, which is a huge discount for a company of GSK's size and foothold. Analysing GSK's forecasted annual earnings, we can see that it's expected to grow 10.8%, which is lower than that of its industry of 22.3%, and also the market of 19.6%. Also, looking at GSK's forecasted annual growth, it is only expected to grow 3.8% in comparison to its industry of 7.8%, but greater than that of the market of 3.2%. Like I've said previously, GSK isn't a growth stock, and therefore growth can be limited for a company of its size. Looking at the past earnings growth analysis, we can see that over the past 5 years, GSK has returned a negative 16.5% return, whereas the industry has returned 13.4% and the market has returned 13%. However, GSK has redeemed itself over the past year, returning 37.6%, beating the industry of 26% and the market of 3.4%. If we move on to the financial position of GSK, we can see that it does not cover its short-term liabilities, nor does it cover its long-term liabilities. So we must take this into account when assessing whether or not to decide to invest in GSK. Moving on to GSK's dividend, it currently offers a yield of 4.97%, with its ex-dividend date coming up on the 14th of May, which is being paid on the 9th of July. This dividend has been stable and has also been increased over the past 10 years. GSK's yield in comparison to the market falls between the highest and the lowest, paying 25% in the UK's market. However, its yield is higher than the 3.6% of which its industry averages. Finally, to wrap the analysis up, we can see that the current payout ratio is 74%, which is expected to drop to 63% in the next 3 years. So that wraps up this video on 3 UK stocks going ex-dividend soon. Leave a message below whether you own any of these stocks or if you plan to purchase them. So thanks for watching, guys. If you've liked this video, please give it a like. Subscribe if you want to see more content like this. I upload an array of videos such as stock analysis and also have a weekly dividend portfolio update in which I update you guys on which stocks I have purchased and sold throughout the week, and also how the current holdings have also performed over the week. So until next time, peace.